In the last 2 years, the world's central banks have executed a financial maneuver so large it has reshaped the global gold market. They've bought over 2,100 tons of gold, not shares in a gold ETF, not futures contracts, not paper promises, physical metal, bars stamped and verified, loaded into armored trucks, locked in sovereign vaults from Beijing to Warsaw, 2,100 tons, a staggering amount. But here's what should keep you awake at night. This isn't about making money. Central banks don't speculate, they don't chase rallies, they don't buy assets hoping they'll appreciate 20% by next quarter. This is about something far bigger. This is about monetary survival. So why are the architects of our digital money system, the very institutions that create currency with a keystroke, desperately stockpiling the oldest asset on Earth? That question drives everything that follows. Now let me give you the number that started this investigation. In 2023, central banks globally purchased over 1,037 metric tons of gold. To understand the magnitude, consider this. The world's largest gold mine produces roughly 90 tons per year. Central banks bought more than 10 times that in 12 months. And 2023 wasn't an anomaly, it was a continuation. 2022 saw over 1,100 tons acquired. Before that, central banks had already been net buyers for 13 consecutive years. The acceleration has been vertical. In 2010, central banks bought 77 tons. By 2019, 650 tons. Then came 2022 and 2023, back-to-back years that shattered every record since 1967. These aren't momentum traders chasing price action. These are the most methodical, conservative financial institutions on Earth. When a central bank decides to accumulate gold, that decision passed through layers of analysis, committee review, and strategic validation. And somehow, independently, central banks across the globe, with different political systems, different economies, different strategic interests, all reach the same conclusion. Buy gold, buy more gold, buy gold now. This single pattern forces three urgent questions. Is this a strategic bet against the dollar? A defensive move against financial warfare? Or is it something deeper, a vote of no confidence in the very monetary system they built? The answer connects all three. Let me show you. First question, is this about the dollar? The data says yes. At the turn of the millennium, the United States dollar represented 71% of global foreign exchange reserves, nearly 3/4 of every reserve currency held by every central bank on Earth. Today, 58%, and falling. 13 percentage points over 24 years might sound modest. In the glacial world of reserve currency management, this is a tectonic shift. Trillions of dollars reallocated away from dollar-denominated assets. Where is it going? Some flows to the euro, some to the yuan, but the single largest beneficiary isn't a currency at all. It's gold. Follow the buyers. The People's Bank of China has been the most consistent accumulator, adding over 200 tons in 2023 alone. Analysts tracking physical flows suggest actual accumulation may be double or triple official figures. China reports what it wants, when it wants. Poland, a NATO ally, a Western-aligned nation, has been among the most aggressive buyers in Europe. Their central bank governor stated openly that gold strengthens the financial security of the country. Singapore, India, Turkey, Czech Republic, Qatar, United Arab Emirates, map these buyers geographically. What do they share? They're not betting against the dollar because they hate America. They're diversifying because they understand concentration is vulnerability. For decades, dollar dominance was self-reinforcing. You held dollars because everyone held dollars. Network effects created momentum, but network effects can reverse. And once they begin reversing, the same dynamics that created dominance accelerate decline. These central banks aren't predicting collapse. They're hedging against a world where holding 70% of reserves in one nation's currency, a nation with $35 trillion in debt, looks less like prudent management and more like concentrated risk. Gold offers what no currency can: neutrality. A gold bar doesn't care about American elections. It doesn't fluctuate with Federal Reserve announcements. It carries no political baggage because it has no issuing nation. In a fracturing world, gold is the one reserve asset everyone agrees has value. Americans trust it. Chinese trust it. Russians trust it. Europeans trust it. That consensus, in an era of deepening division, is worth more than any yield. Second question, is this about sanctions? Rewind to February 2022. Russia invaded Ukraine. Within days, Western response materialized. And it wasn't primarily military. It was financial. The The United States and European Union froze approximately half of Russia's foreign exchange reserves. $300 billion. Immobilized, inaccessible, rendered worthless with a bureaucratic keystroke. For Russia, devastating. But for every finance minister watching from every capital outside the Western alliance, this was something else entirely. Education. Think about what that freeze demonstrated. A U.S. Treasury bond, supposedly the safest asset in the world, is only safe if the United States government allows you to access it. A euro deposit is only yours if European regulators don't decide otherwise. A SWIFT transaction only clears if you remain in good standing with the consortium that controls global payments. Every digital asset, every foreign currency holding, every bond and deposit, all of it exists at the pleasure of nations controlling the financial infrastructure. For decades, this was theoretical, background risk too extreme for serious planning. After February 2022, operational reality. Put yourself in the position of a central bank governor anywhere with independent foreign policy ambitions. You might be a close American ally today. What about in 5 years, 10 years, 20 years? Political alignments shift. Alliances fracture. Today's partner becomes tomorrow's rival. Do you want your nation's wealth stored in a form that can be switched off by a foreign government? Or do you want at least a portion in a form that physically exists within your borders, under your control, with zero counterparty risk? The answer, for growing numbers of nations, is obvious. Gold held in domestic vaults is sovereignty in physical form. It cannot be sanctioned, cannot be frozen, cannot be digitally deleted. Short of physical invasion, it cannot be taken. The data confirms this response. China, already a significant buyer, pushed accumulation into overdrive after 2022. India increased purchases substantially. Middle Eastern nations began transferring gold from London vaults back to domestic storage. Even nations with no immediate sanctions risks started reevaluating, because the lesson wasn't about Russia specifically. It was about the nature of modern finance itself. Any asset you don't physically control is an asset someone else can control. The freeze of Russian reserves didn't just punish Russia, it fundamentally altered risk calculus for every nation on Earth. And gold, ancient, simple, physical gold, suddenly looked like the most sophisticated financial technology available. Not despite its primitiveness, because of it. Third question. Is this about trust in the system itself? This is the most uncomfortable question. Because it implicates the institutions doing the buying. Central banks don't just hold reserves, they create money. They are the source code of fiat currency. Every dollar, euro, and yuan in existence was conjured by these very institutions. And they're buying gold. Think about what that implies. The people with the deepest understanding of how fiat currency works, the people who attend the meetings, see the balance sheets, understand exactly how money is created and destroyed, are choosing to allocate meaningful reserves into an asset that cannot be printed. This isn't gold bug paranoia. This is revealed preference. The most informed actors in the monetary system are voting with their vault allocations. Consider the trajectory. After 2008, central banks globally embarked on unprecedented experimentation, quantitative easing, zero interest rates, negative rates, balance sheet expansion that would have seemed hallucinatory a generation earlier. The Federal Reserve's balance sheet went from under $1 trillion to nearly $9 trillion at peak. The European Central Bank followed similar patterns. The Bank of Japan's balance sheet now exceeds Japan's entire GDP. We were told this was temporary. Emergency measures for emergency times. The money would be unwound. Balance sheets would normalize. They haven't. And the people who understand exactly why, who know that unwinding these positions without crashing markets is somewhere between difficult and impossible, are buying gold. This isn't speculation about motives. This is observation of actions. When your physician starts exercising obsessively and cutting sugar, you don't need them to explain concerns about heart disease. Behavior tells you everything. When central banks accumulate gold at record pace while maintaining the fiat system is sound, behavior tells you what press releases never will. The experiment in unlimited money creation has consequences. The architects know it. They're positioning accordingly. So what's the verdict? This isn't a story of or, it's a story of and. Geopolitical de-dollarization has created the motive. Nations with independent ambitions no longer want wealth denominated entirely in one power's currency, no matter how dominant the power appears today. Financial warfare through sanctions has provided the urgent catalyst. After watching $300 billion frozen with a keystroke, no serious nation ignores the counterparty risk embedded in every digital asset, every foreign account controlled by foreign institutions. Institutional distrust of monetary excess has supplied unwavering conviction. The people who understand fiat currency best are hedging against its long-term stability. Together, these forces form a perfect storm, not arriving someday, already underway, measured in tonnage and vault transfers and the quiet repositioning of sovereign wealth. Now let's talk about what this means for markets, for the system, and for you. When central banks become major gold buyers, they change market structure fundamentally. Retail investors buy based on price. If gold rises too fast, they take profits. If it falls, they panic sell. Their behavior creates normal volatility. Central banks don't operate this way. A central bank acquiring gold for strategic reserves doesn't care if it's buying at $4,000 or $5,000 per ounce. They're not timing markets. They're not chasing returns. They're executing multi-decade strategy to rebalance national wealth away from concentrated currency risk. This creates what traders call a price-insensitive buyer. Every year, 1,000 tons gets absorbed by institutions that won't sell regardless of price. Supply that never returns to market. A permanent bid underneath prices no amount of retail selling can overcome. Mining produces approximately 3,500 tons annually. Central banks absorb nearly a third without flinching at price. What happens when consistent, price-insensitive buying absorbs a third of new supply every single year? Exactly what you'd expect. Prices find a floor, pullbacks get bought, supply-demand structure shifts towards scarcity. This isn't prediction. This is mathematics. For the dollar system, implications unfold slower but run profound. No serious analyst expects the dollar to lose reserve status next year or in 5 years. These transitions take decades, but direction matters more than speed. When central banks held 71% in dollars, they expressed maximum confidence in American monetary policy. That confidence allowed the United States to run deficits that would destroy any other nation's currency, borrowing at rates that didn't reflect actual risk. At 58% and falling, confidence is eroding, not collapsing. Eroding. Each percentage point lost represents hundreds of billions in demand that no longer automatically flows into treasury bonds. Each gold purchase represents dollars that weren't created to settle international trade. The privileges America enjoys from dollar dominance, sanctioning enemies, running perpetual deficits, exporting inflation, rest on voluntary participation. Central banks are signaling through gold accumulation that participation is becoming less voluntary. Alternatives are being constructed. The dollar system, while still dominant, is no longer the only option. The central bank gold rush is the most significant financial signal hiding in plain sight. It doesn't generate headlines because it's not dramatic. No crash, no crisis moment, no single event to point at. Instead, steady accumulation of a physical metal by the world's most conservative financial institutions, vault by vault, ton by ton, year after year. They're not panicking. They're preparing. They're not speculating. They're positioning. And their position, over 2,000 tons in just 2 years, sends a message louder than any press release. The system is changing. Foundations are shifting. Old assumptions about dollar dominance, fiat stability, the permanence of current monetary order, quietly being revised, not in academic papers or congressional testimonies, in vault inventories. They're hedging against uncertainty. They're accumulating the one asset that has preserved wealth through every monetary transition in human history. The question is, are you? If you found this investigation valuable, subscribe. We decode the signals the powerful send with their money, not what they say, but what they do. And let us know in the comments, which motive, geopolitics, sanctions, or distrust, do you believe is the most powerful driver? The conversation starts now.